Welcome to Fintech CTO Talks, the podcast that goes behind the scenes with the tech leaders, solving the challenges and rewriting the rules of finance. Money moves fast. Does Fintech keep up? Let's find out. I am Ami and I sit down with CTOs, engineers, investors who are making finances smarter, smoother, and connected. Together, we'll explore the platforms, the codes, the bold ideas shaping the financial technology, and yes, making it a little fun on the way together. Today's guest has spent nearly 2 decades at the intersection of venture capital, company building, and financial infrastructure, and he's seen it from every angle: investor, operator, and founder. Dan DeLasta began his career in investment banking at Bank of America Merrill Lynch before pivoting to the venture world as a founding team member of Route 66, a fintech and insurtech focused fund where he helped deploy over $160 million across 27 companies spanning North America, Europe, and Southeast Asia. The portfolios includes names like Ripple Labs and DriveWealth, and the fund has already returned significant capital. From there, Dan moved to the operator side. He joined embedded finance platform Rise in 2020, and now he is channeling all of that, the deal, the operator instincts, the fintech pattern recognition into something of his own. He's co-founded Citron Venture Partners, a VC firm writing pre-seed and seed checks into AI and fintech companies across North America, Europe, and Latin America. Citron leads early rounds, works closely with founders on strategy and GTMs, and takes a research driven thesis approach to backing capital efficient builders. Today, on this podcast, he would be talking about designing the outcomes of capital efficiency, optimal exits, and long term values. Dan, great to have you on the podcast. Welcome to the show.
Thank you very much for having me.
Perfect. So, we'll begin.
Yes, let's go.
Perfect. I'm going to throw questions to you and, let's go ahead. So, my first question is, there's a growing school of thought currently that the default alive mentality, where every dollar has to earn its place, actually produces better companies than those that rise big, figure it out later. So, is it true? Or is there a version of, fintech where aggressive capital deployment is genuinely the right strategy, not just from a VC narrative?
Yeah, great question. And I think it's important to know where we are, from a macro perspective compared to what venture capital looked like in the last decade. So recall, or particularly in the last wave of fintech that happened post financial crisis, interest rates approached and then were at zero for quite some time, which effectively meant that institutional investors all around the world were looking for yield. And so venture capital is one of the only places you can get significant yield on a risk reward basis. And so many dollars flowed in. And so I think there was a lot of, most companies were, of course, not reckless, but I think it was a lot easier to raise capital, a lot easier to spend money. And now fast forward to today, the general feeling is that rates will not be going down to those levels at any time soon, and so venture capital is back in its rightful place on high on the risk reward curve, because now dollars are not going to be as free free to raise in the past, both for venture capital funds as well as startups that are attracting venture capital dollars. So the default, of course, has to be, because dollars are now scarce again in the early stage world. How are you going to be efficient and spend those dollars wisely? Because you don't know how the next round of funding will go. And so you need to be very thoughtful in how much you raise and the capital trajectory that you're on. Now, that being said, we are also at a technological chasm, so to speak, similar to when the internet was being born in the late 90s, where the fundamental landscape is completely changing. And then when people need to marry physical infrastructure with new ways of building everything along the tech stack, that is going to be expensive. And so we're obviously seeing those companies raise billions upon billions of dollars to do that. But outside of those exceptions, by and large, the companies that need to grow from the earliest stages need to do so with capital efficiency in mind, nail product market fit, nail distribution, and then from there they could be a bit more ready to take on more capital when they've reached those proof points.
So when you're talking about this, like I would like to understand that fintech is a sector where regulatory compliances, licensing, the infrastructure costs are non-negotiable. So you can't cut your way to capital efficiency the same way, a pure SaaS company can do. So how do you think about the efficiency benchmarks specifically into fintech, and where some of that burn is structural, not founder failure, if we talk from the startup point of view?
So thank you. Great question. I've been a part of some fintechs that have had to raise significant capital because they're at the infrastructure layer and they need to map all of the regulatory compliance and legal elements of how to conduct transactions appropriately, how to onboard customers appropriately, how to make sure that nothing is being run afoul, because they're looking to partner with the largest FIs that just have, again, as you said, these are non-negotiables. Now, the way to solve them in the past was to throw a lot of engineers at the problem. And so I think absolutely those tasks cannot be short circuited, or cannot be shortcuts can't be taken at all. But this is specifically where AI can come into the picture and help cut the heavy resource need to be able to do that. Now, this is a world where we can't replace all those engineers, because you need subject matter experts that know it in and out. So I think, unlike some maybe other sectors, we're like, okay, great, we can go cut from 100 engineers down to one. It won't be as drastic as that, because we need to make sure that there are the right people reviewing, because you cannot get this stuff wrong. But the heavy need that existed a decade ago, our estimates are that those types of costs can be cut by 2/3 or so.
Okay. But like there are a lot of founders, who confuse themselves. Frugality with the capital efficiency, they are not the same thing. So, like, one is about spending less, the other is about generating maximum results or output, like per dollar deployed. So, how do you help specifically, or the organization or VC, as the complete
Yeah.
ecosystem, help founders to make the distinctions, the decisions, and where do you see them getting their lows, the wrong the most?
Yeah, again, we help founders we rely on our founders to come to us and tell us, okay, I've identified a problem that needs solving for, or I've identified an opportunity that me and only me has an idea that can seize on this opportunity. Where we help is, I think, where a lot of founders sometimes don't don't make it all the way, or in the early days things sometimes falter, is they've not figured out the correct sample size or the correct testing to see if they have product market fit or not.
Yes.
And so I think where we want to make sure dollars are being spent, and indeed, like, we need to spend the right amount of dollars, is, are you in front of the right institutions or people that is testing if you have really nailed this product market fit or not? And that's not just, I don't want to see false positives or false negatives. Like, we need the right diverse set of, okay, I'm just making examples up. I've talked to small, medium, and large institutions. I've talked to people across the gamut of the procurement cycle at these institutions to know that I'm able to replicate sales across these different types of orgs. And on the consumer side, similarly, I'm not just targeting, or I'm not just in front of a specific group of people in one specific geography, in one specific strata, unless that is the only problem you're looking to solve. So we advise, don't waste dollars on the wrong tests. We want to make sure that we're spending the right amount of dollars that are generating we're testing the right hypotheses and using the right experiments to validate the hypothesis or not.
Correct. So when you're talking about that, like, numbers look great on spreadsheets at early scale or not early levels, and then completely fall apart during a series B or series C. And when CAC creeps up or LTV assumptions don't hold. So, what are the early warning signs? Like, you can tell that a company is efficient, or, the story is right, just right, or it is just all on paper.
Yeah, good question. Yeah, I think where that has occurred, it's they've usually found their results in the early days have been false positives because they have been use their product has been they grabbed the best part of the market too early, and then now when they start trying to go wider, they realize, okay, our solution or our offering isn't as applicable across wider segments, or indeed it's much more expensive to acquire customers in wider segments that they've been in one respect lucky that, like, great, the customer base that loves our product, we've been able to get them super early. But if there's not enough of them, or they've not identified a large enough market, serviceable, addressable market, then they're almost out of opportunities. So again, it's a matter of how are we setting up our tests early on to know that as we go wider, we're not just getting more inefficient in our economics, but rather, we actually can model this out because we've tested out on a broad enough customer segment.
Okay. And like when we talk about founders, most founders, never seriously game out their exit until they are in middle of one, and then there is panic set in, the leverage is gone. So what does it look like to architect an exit from the early stages, and what decisions at year one or two meaningfully can be expanded into the future or later, like 5 years later?
Yeah, so we advise our founders. We're trying to build companies of great value that we're never necessarily looking to exit early, but you never know what's going to happen in the market. You never know if you've hit on something that is of tremendous value to any specific buyer base. So how to architect exits first and foremost is making sure that the potential buyers of your business know who you are, and they need to know who you are, and these usually take long relationships. And so early on, it's just being out in market. You're not selling yourself. You're not saying, hey, I want to exit in 5 years to you, but it's more, I'm a known quantity, so that when the time comes where you do want to explore either an exit, or if you have really achieve some type of velocity in some certain lane, that those buyers are aware of your actions, and that they may be they it's better to be bought than be sold, of course, but it's always good to keep these buyers apprised of your own progress, so that again, first and foremost, before you can architect the mechanics of the exit, the buyer needs to know who you are. Better to have that relationship direct than have a cold introduction from an intermediary. There's a great role for intermediaries to actually help with the mechanics of the deal, but first and foremost, it's founders need to be known by the potential buyers out there. So it's not wasted effort. I think too often founders are afraid of, well, if they know what I'm doing, they're going to copy me or steal my ideas. I've worked in enough large institutions where even if they wanted to steal your idea, it would take them 5 years to do so. And at this day and age, you're the smaller founders in a much better position to move fast. So I'd be less concerned at any idea stealing, and more concerned with just them knowing the general parameters of what you're working on, because yeah, it's if you ever need an exit because of either some macro shocks to the system, or tight finances, you want to make sure that you know who to call, and that you have those numbers.
Okay. So when you're talking about, someone stealing the idea, so there is a concept called acqui-hire, versus acquisitions versus
Yeah.
strategic premium. So like three very different outcomes that can all get called out and as an exit. So what actually determines which category you fall in, how much of that is, into a founder's control versus just market timing?
Yeah, I mean, so each of those usually will represent, where the relative leverage and the state of the business of the acquired entity. So most acqui-hires are happening because They recognize there's value in the people, but potentially there's not significant value that can be created. Like they're like from the actual product or offering, there likely isn't a massive increment, a massive change in how the buyer will be able to ingest and create significant value from that. But they recognize you have good people, and there's something worth salvaging rather than just letting the company go to zero. That's usually not an outcome that's great for investors, but the team has done enough to prove that they're worth. And on the far end of the spectrum, every sale process I've been a part of, we're trying to find the buyer that is able to for the next 3, 5, 10 years, see how our offering will be integrated into their business and how they're going to achieve outsized value. That 1 + 1 can equal 3, because only our business mixed with yours can really create that accretion. And so that's what you need to. It's almost your job as the founder to identify which are the institutions, which are the buyers that are going to value what I've built the most, and I need to really focus on that buyer base. And so that's usually can create hopefully some competitive tension among, if there's more than one. But two, that's where you have a bit more leverage, because the buyer sees, oh, if I can bring them in, I can have some outsized return myself. So again, it's all relative to who's the audience, who is your offering matching or enhancing the value of what the buyer is trying to do for their own vision. And so it's best to identify that early on in an exit process, rather than just going through a Rolodex and having less method and categorization across everyone you're speaking to.
Okay. So, when a small or a medium-sized fintech company gets acquired by a large financial institution, so does the value die down, or does it get killed, for what they have been acquired for? And, is there a structure where actually that can be preserved, the innovation, what they have done, or is it just an inherent tension that can't be solved?
Yeah, I mean, it's hard to know it before the acquisition is done, but you do your best to understand what the culture of the organization is, where you will fit in the hierarchy and the organization. Will you be a standalone entity that reports into its own line of business, or will you be ingested directly into an existing line of business? The by and large, that's not always the case. I think when a self-sufficient standalone fintech company that's proven its worth is brought into a large organization, ideally that company is as least disrupted as possible on day one, and then slowly over time, if the plan is to integrate them into a specific line of business, that it's done slowly and carefully and over time, because you don't want to all of a sudden introduce such a shock into what has been working for that business. But at the end of the day, the buyer likely won't realize the full benefits of the transaction until their brand and their DNA has really matched with that fintech. So whether it's a year, whether it's 5 years, at some point that buyer does need that acquired entity should become part of the larger whole, and so everyone can recognize, the buyer can really recognize their own brand value accretion from a strong business they've acquired.
And parallelly, when we talk about IPO window, it has, largely been closed for fintech for a couple of years from now. So that's pushed more outcome towards the M&A. But has M&A introduced its own distortions, particularly around the valuations anchoring from the prior rounds? How do founders navigate that?
Yeah, it's a great. I mean, I think founders should also look at there is increasingly now a third avenue of exit, which is private market or secondary shares to be sold, and I think. Yeah, so I think that is the way to help mitigate, what is the ups and downs of the IPO market and the challenges of the M&A market. Is there are still hungry private market investors that are later stage that would love access into earlier stage deals that have proven out some of their worth. So you're seeing, companies themselves doing some share tender offers, Stripe and Ripple Labs, and or have been doing much, and they've been in the press over the last several quarters, as well as a lot of private markets platforms have been stood up to facilitate the trading of early shares held by early employees or early investors, that can enable another route to create liquidity without having to only go the IPO and M&A route. So I think I was looking at the statistics the other day. The rate of growth of liquidity being created by that third pillar has grown immensely, and is almost on par, particularly in a fintech, with some of those with those other two pillars. So, again, those are your three exit vehicles. That third often doesn't require going through those two big processes, and can allow you as a company to create liquidity for your shareholders without having to deal with that pressure, while just building the business. And then, if you're ready, again, be bought, not sold. And if it's time to go public, you want to make sure that your company is healthy enough to withstand the public market scrutiny. So, yeah, ideally, you're just able to focus on building a great business, and then those outcomes will find their way to you, rather than try to force your way into one of either the IPO window or M&A.
So when we talk about technology, because it's all there, and especially today when AI is there into everything. So how is AI reshaping, the fintech startups or the fintech as an ecosystem? Has it grown? Is it evolving? Or, where does that stand actually?
I'm sorry, you broke up there a little bit. Would you mind repeating the question?
Yeah, sure, sure. Like, let's talk technology. Like today, everything is about AI. Everyone, every sector is talking about AI. So, how is AI reshaping fintech as an ecosystem? Is it growing? Is it evolving? Or is it taking baby steps? Where is it actually right now?
Yeah, it's here in Las Vegas, at Fintech Meetup. I mean, it's hard and it's front and center with most conversations. I think because of the regulated nature of this industry, and just the array of products and services that are within the large spectrum of financial services creates so many opportunities for efficiencies to be born. And so I think that AI is excellent at solving some of those things, again, that take just a lot of money and people to solve for. But I think, unlike other industries, there is just specific subject matter expertise required to be able to create the right types of products, to offer the right types of services, that exist in this industry, that creates a bit of a moat of full AI disruption. Like it's difficult to see a world where an AI bank can come in and just become the new default bank, or an AI brokerage platform, and go down the list. I think that AI needs to be part of everyone's tech stack, but it can't take over, because there are just expertise required. So I think, to answer your question, if it's not part of your solution moving forward, you will lose, but it can't be the solution moving forward. It needs to be part of a broader mix.
Okay. So there is a meaningful difference between a company that creates value and the one which captures, the value in the fintech basically. And that line gets a bit blurry. So you being into the ecosystem, you can build something genuinely useful that gets commoditized. So something defensible that extracts rent. How do you think that, designing for both real value while building a moat that lets you capture it? How does it work?
Yeah, I mean, it's a great question, and if I knew the exact answer to that, I would be retired on a beach somewhere, I suppose. But the the I think where what is unknown, how do I put this? The the world of money moving and changing hands, and the world of investing, and the world of insurance and risk management, these have been around for hundreds of years. and so in this industry generally knows how to accomplish those things. I think, where value is created is when those functions, which again, like people know what the things that need to be solved and how to accomplish them, but there's just so much layer of let's call it friction, due to all of the safeguards that need to be in place, and due to the difficulties of finding where the right arbitrage lays across different strata of data. And so, technology can come in and systematically either make those line items across that friction either cheaper, more expensive, or replaced altogether, and just removed from the system. And so, we rely on at Citrine, we rely on finding we expect our founders to be subject matter experts somewhere in the silo across the world of financial services that understands this specific area within this world, can be made either obsolete or can be made more efficient, or I have a better way to do this. And so that person has built over decades the expertise required to identify that, and so that's where we spend our time really trying to find that individual or that founding team that knows how to take the technological tools and apply them into a very specific area. Now, there will be horizontal plays that say, well, I have a new way to, I've built a tool that can better underwrite risk across all strata of populations. Terrific. That means that insurance could use that, credit could use that, and basically all along the way. But again, that will still require founders that know, how is risk measured? And so once I know how risk is measured, I then can attack it. So I think the long and short of it is the only way to understand or the only way to create or capture value is by someone knowing what it is, what is the value of that exists currently across a specific problem set, and then from there understanding what can be created or what can be captured. Hopefully that answered the question a little bit.
Perfect. Dan, just one thing in between. You will need to sit like this because, like, you have blurred your screen, and when you move, half your ears and everything gets cut out.
Yeah.
So I don't want that to happen. Yeah,
Yeah.
this
Okay,
looks
say that
nice.
one. So basically try to sit
Yeah,
like
yeah,
this.
yeah, yeah. Because like your ears and everything is just getting cut out. It will not look nice from your
Got
part.
it. Got it. Oh, I understand, because of the blur. Yeah.
Yeah,
Thank you.
yeah,
Oh,
yeah,
yeah.
yeah.
Good call.
Perfect. Dan, there are a few other questions I want to ask, but I'll just take one last question
Sure.
in the flow. Like, if you zoom all the way past the cycles, the fund cycles, the exit timelines, past the quarterly metrics, is what does a fintech company have to be in order to matter a decade from now? And what's the actual thesis for a long term relevance in the fintech sector? Because that's moving fast these days.
Yeah. I mean, I think, those of us who were of age to know, to have lived through the financial crisis, know that was a moment in time that I think before that there was some general trust in who you banked with or who you did business with your finances, and then after that, again, not for everybody, but the general population lost trust in that. And so I think it was easy. Well, I don't care who I bank with. I'll go with whoever's cheaper, or I could do a service more. I remember last decade, I had maybe 30 apps on my phone. Each one would do this separate thing. I
Yes.
didn't care where my money was. I would just move it around. And so I think like we're slowly, I think what we've seen with the rise of companies like Revolut and Nubank, and Robinhood on the trading side, and the list goes on across different pillars, is that if you can reliably um, uh, bring a product and service that works, and you're not screwing over your customer base. And again, whether this applies on the B2B or the direct consumer side, that pays off. And so I think a decade from now, a successful fintech needs to revert back to what made financial institutions great for so long, which was like they established great trust, and always did right by their customer. Again, whether that's a business or whether that's a consumer. And so rather than be focused on constantly iterating and changing experiences, I think just knowing that for the long haul, if I want this customer to be with me, 10 years from now, it's a matter of being reliable and trying to earn that trust. So, and then, again, applicable on the B2B side, it's I'm providing a service and I'm not messing up, and I'm doing it right every time. And if when mistakes do happen, I'm being open and forthright about it. So yeah, I think that's something aside from tech, aside from UI and UX. I think that's something that, the only thing people hate to be people hate to be told how to raise their children. The only thing they hate to be told more than that is how to manage their money. But people need that advice very well. So establishing a
Correct.
really close, trusted relationship is the most important thing for long term customer traction.
Absolutely. So, like, we'll move on to the next segment. That's the rapid fire round. I'll ask you a few questions. You'll have to be quick in answering. It can be one word or max one sentence.
Ooh, okay.
Fintech or AI? Pick one.
Fintech.
Elon Musk launching X money, disruption or distraction?
I think the distraction will be the disruption.
Okay. First check or lead round?
First check.
If Buffett started a fintech company tomorrow, what would it be?
Investment planning.
Crypto, future or fad?
Still future.
Okay.
We have the dollar reserve, and well, no more rapid fire, but yeah, still future. Yeah.
Okay. The one founder, alive or dead, you'd back with a blank check, no questions asked.
Nick Hungerford, he founded Nutmeg, and
Hmm.
helped me fall in love with fintech. Yeah.
Okay. Mark Anderson or Charlie Munger, whose investing philosophy do you actually live by?
Uh, I live by Charlie Munger, but I want my founders to be more Andreessen.
Okay. The one word you want every founder you back to embody.
Magnanimity.
Perfect. Last question. The one person in finance history who got it most right.
Oh gosh. I've been informed. I'd say Jamie Dimon of JP Morgan.
Yeah, yes. Nice one. We'll move on to the next segment, and that's you'll have to answer just one question into 30 seconds. That is, what is the role of AI in capital efficiency, optimal exits, and long-term value?
Yeah, great. So AI will enable me to build large businesses with a fraction of the resources, a fraction of the expense, and a fraction of the cost base that it did a decade ago or even 5 years ago. So this enables my exit if I can't reach billion or unicorn status, even if I exit for a few $100 million. If I've only raised a fraction of what I had before, that's still a generational exit, and wealth creation for the team and for your early investors.
Thank you, Dan, for the podcast, for the time and amazing information what you have shared today.
No, thank you. That was great. I had a great time. Thank you so much.
Perfect. So, everyone, let's stay connected. We continue to explore and understand the evolving world of financial technology. That was Dan sharing his experience and perspective to Fintech CTO Talks. Thanks for tuning in. We will meet in the next episode next week. Until then, stay curious, stay inspired, and keep exploring.